Hello, good afternoon. Thank everybody for coming. I'm Sarah from RK Tongue. Mark is here from NorthEast Brokerage, where we do the majority of our life insurance, and Lyndon is here as well. He is the one that organizes and is our marketing guy here at RK Tongue. So we're going to go ahead and get started. We're going to run through a brief presentation. If anybody has any questions, feel free to stop and ask questions as we go. So Mark, we'll let you go ahead and get started.
Good afternoon. Can everyone hear us all right? Good. All right, so we're going to spend some time this afternoon just going through basic, thank you for responding, basic needs analysis and review as to what we're looking for in the protection arena, particularly today with life insurance as to what the issues that we focus in on. Let me kind of go through. All righty. So historically, when we look at the population that's out there, a lot of people don't really understand life insurance costs, the parameters that drive products, the designs. We'll get into some of that stuff a little bit today, but it's always interesting to me that so many people think that it's too expensive or that they don't need it, or that they check off the box that they've got life insurance because their employer has provided the coverages. And so we'll kind of go through some of those areas this afternoon and address that for you. Statistically, ownership right now is a little bit higher with men than women. That number has certainly gotten much closer over the last few years, but still a little bit of disparity between the two. 11% in the most recent review between men and women in life insurance, yet today, women's income is just as important to the household as that of men's. Often I see significantly more income with women than men. So it's interesting that the life insurance is still a little bit off pace in relation to the gender issue. When you're looking at financial planning, I've been doing this for a long time, and I always remember back in my early days that they stressed the pyramid. But we don't live in pyramids anymore. Today we live in houses. And so if we kind of remember the base of your house, the foundation for your financial planning, are some of the insurance issues that protect your house and those in it if something should happen to you. Certainly disability insurance is a main foundation for any financial planning, because without your income, you don't have the ability to save for retirement, to pay off your mortgage, to pay your rent, to eat. Everything else revolves around that income stream. And certainly in the protection arena, life insurance falls into that area as well, because like disability, for somebody being disabled, if somebody passes, their income also stops for the household. And so if you're trying to protect the house, you've got to have those basic things taken care of and buttoned up before we get into the accumulation, or what we call here is the future planning mechanisms, or legacy planning mechanisms once we really got things rolling forward. People buy life insurance. I'll go through these a little slowly here. Provide income for loved ones. To me, the number one reason that people buy life insurance often is because they want to cover a mortgage, or because they've got a bank loan where it's required for coverages or protections. But really, income protection to me is the most important component. Without your income coming into the household, all the other goals, as we just talked about, kind of fade away. Certainly covering the mortgages, which may be college loans, might be large automobile loans, but for most people, the biggest debt to contend with is certainly the mortgage on the home. And then there are other areas that we look in protection. If something happens and my income stops because I've become disabled or passed, what other goals do I have? To give my mother-in-law $100,000 a year income stream? Probably not, but maybe to take care of my kids' educational goals, maybe to take care of burial final expenses, maybe to leave some money to specific charities that I have, a strong belief in. So the goals vary for each individual, but these are just a few of the big topics that we ought to be focusing on when we're looking at life insurance protection. I find that sometimes people overcomplicate this area, and I don't think it needs to be. I think if you focus on those big issues that were on the last slide, the income protection, the debt, and the specific areas that are of interest to you, you can comprehensively cover the life insurance. The next part after that would be to figure out, after you figured out how much, it's how long. So this is a calculator that I'll have Sarah send out to all of you that attended today. You can kind of play with on your own. Up on the top, it mentions cash needs at death. So you can put in, 10,000 for medical expenses and final expenses. You could bump that number to 15,000. Certainly somebody's own mortgage that they've got. So maybe the mortgage in today's world is not $80,000, but $480,000. Other debt, maybe they've got some credit card debt or automobile insurance debt. If they've got kids, if you're trying to protect in today's terms, are you funding a child's private school education or a state university education? There's a difference as to how much you need for protection. Obviously, the number of children that you have in the mix too comes into play. And then you've got charitable contributions or an emergency fund. So if we look at that cash at death, those are the items that would be needed to satisfy where you need that cash liquidity right away. So the $575,000 is reflected over here. Okay. Most individuals, their households, you need 70 to 80% of the current income stream to come into a survivor. So that doesn't mean what your total income is, that means what your net income is after taxes. So if you're making $100,000 a year, maybe you're looking at, $5,000 or $6,000 a month for the survivorship. So if we put that $5,000 a month in there, and maybe we're going to need it for the next 20 years, and we would assume that the money that comes into the life insurance, from the life insurance, it comes in tax-free, it's invested someplace. Most financial planners will tell you to budget between 4 and 6% rate of return. We'll leave it at the 6 and we'll put inflation at 2, although we've certainly seen that a little bit higher. So our survivorship income with that specific scenario drives it up to $828,000 that's necessary for survivorship. The two together bring us to 1.4 million. But if we've got, money that's not in a retirement account that's liquid, that's going to reduce it. If we've got group employer insurance because our employer is providing, 2 times income or something, that offsets it. So your offsets are now here, reducing the overall amount that you've got. An interesting button that's on here, if you check the button preserve principal, that means that at the end of the 20 years, you've provided all that income stream of $5,000 a month, but you still have your principal intact. So for a lot of people, if their $5,000 a month for survivorship isn't enough money for the spouse to save for retirement, then they'd want to have preserve the principal button checked to do that. And obviously that bumps up the survivor to $1.5 million. So again, without it, it's 800,000. With it, it's 1.5 million. Okay. So one thing to keep into consideration too, if I'm generating enough monthly income to take care of my family's expenses, if my income stops, I don't necessarily need to pay off the house and have full income protection coming in at the same time. It's an either or. So if this 5,000 a month takes care of the mortgage and all expenses and education, everything else, I could conceivably move my mortgage debt down to zero. And that reduces that down to $95,000 that you needed there. So the nice thing about this calculator is you can play with these numbers all over the place, monthly income, cash needed at death. And when you get done, it flips it into a nice little PowerPoint 2-page presentation that kind of summarizes what you just did. how much is needed at death, how much is needed for survivorship, what your offsets are, and what the net amount is. And then the second page breaks out how you came up with those figures. So just kind of keep that in mind, that you can use the presentation button to kind of reinforce it. If one person is doing it and they want to share the results with a spouse, you can click that to create the two-page PDF that addresses the needs analysis. But I use this calculator day in and day out. Voya, interestingly enough, no longer sells life insurance, but this is one of the best calculators that I've ever run across, and doing this for a long time. So this breaks down the numbers just like I did a minute ago. So if we had $1 million coming in for a surviving family and it earns 5%, that's a $50,000 income stream. So $1 million in life insurance, it certainly doesn't do what it used to do, relative to where income levels are today. And a lot of people will unfortunately make a rounded decision. I'd like $1 million, or I'd like $1.5 million. I encourage people to really work the math and cover what you believe you need to have. If that number is 1.1 million, then get 1.1 million, or 1.1257394, whatever the number is. You don't have to get a rounded number with purchasing life insurance. What you should get is what you feel as though you need to adequately cover those risks that you've determined need to be protected. So our job is to help, elevate those risk factors that you probably ought to be looking at. But ultimately, the individual who is writing the check to cover their family has to come to terms with what areas they feel as though need to be covered and at what level. So in the household, I find it's a very important conversation to have jointly, if it's a married coupled situation. And then for business owners, we run into some of the same situation in looking at life insurance, trying to figure out what the coverage is for. Is it for replacing income to the practice if something were to happen to a professional, in which case we would call it key person coverage, and figure out how much we need in that respect? Or for business purposes, it could be used for buyout purposes, where we are bringing coverage in so that if one of the partners were to pass, we have cash coming in to deal with a purchase of that individual stock, so that their family gets paid in full right up front, and the surviving partner doesn't have to contend with the deceased partner's spouse to continue their business. So big events that often people look at when they buy a house, sometimes that's a re-trigger to, what's my new mortgage? What do I need to have covered? Sometimes when they're getting married or divorced, that changes the financial situation. A lot of times I see divorces where life insurance is a requirement. But certainly in marriage, it should be. Parenthood, to make sure that the kids are taken care of, something should happen to them, is very important. And then taking care of, letting the coverage stay in place long enough until the children are financially independent. And that takes sometimes a little bit longer than we might want it to. Career changes or retirement, certainly sometimes our jobs might afford us more protection, and then we change jobs and then it goes down. So I look at the group insurance that's afforded through an employer is kind of a bonus. I don't put it in the overall plan because I wouldn't want to change jobs and have my family at risk because the new employer's benefits aren't as generous as the current employer's benefits. And most of the time when you're interviewing, they don't get down into the minutia of, what's your multiples for life insurance protection. Usually you find that after you're working in the new job. So that's important, that we look at the group insurance as kind of an ancillary part of the picture for that reason. These are other areas that sometimes we would look to do a review for insurance. If you've got a grandchild that's coming to the mix, death of a family member, new job or promotion, investments, inheritance. I'm not going to read through all these. You can kind of see the list is pretty extensive as to why sometimes we want to do a review of the coverage. I find a lot of individuals buy life insurance they put the policy in a drawer, or nowadays we're saving it electronically on a computer, and then it's forgotten about. And there are a lot of important issues besides how much we have that ought to be evaluated. You know, perhaps a change in the beneficiary. Maybe the children are now adults and should be a part of it in addition to a spouse. Um, you know, so many different things that can review. And the ownership is the drive for any policy. So whoever owns the policy, whether it's a trust, whether it's a business partner, or whether it's the insured, um, that ownership controls who the beneficiary is and everything else about the policies. But we find a lot of times to review existing coverages that there can be savings brought to the table because people either had a change in health, maybe they stopped smoking, maybe they lost weight, um, maybe the amount of coverage that they need today is actually less than what they needed when they took the policy out before, because they've gotten through those hurdle years where children's education were in the mix, or they've paid off the mortgage because maybe they've inherited some money. Um, just reviewing the insurance as to what you've got is a meaningful thing that everybody ought to do. And then certainly to make sure that your family is aware that it exists and where it can be located if something were to happen to you.
Mark, could I ask, um, is there kind of like seasons where is this similar to health insurance where you can only kind of do these reviews or change your policy at certain times?
No, any time of year, it's not restricted. I mean, it's an asset that you own. You buy a stock portfolio, you'd hope that you're not going to buy those stocks and forget about them for 30 years. You're going to manage that portfolio.
Right.
I look at life insurance the same way. It's not that you need to review it every year like you should your financial investments, but every few years to look at it. The number of times that people reach out to me when their 20-year term policy has reached the end of its 20th year and they're now in panic mode because they've got no life insurance or the rate went up 25 times because it was the end of the term. It's good to know these things a little bit of advance. And if I've got a 20-year term policy that's going to end in 2 years, and I know I need coverage for the next 15, it does not make any sense to wait until the policy reaches the full end of the 20th year to fix the problem
Right.
because I might become uninsurable,
Mm,
you know?
good to know. Yeah, for sure.
So, and the sooner that one fixes it, the younger they are and the less expensive it is. Okay. So most people just don't have any idea how inexpensive life insurance can be. We work with over 30 different life insurance companies. So we carefully analyze in that process, what each individual's health is, what their family histories are, what their medications are, whether you've had multiple moving violations, whether you've got international travel planned, all those things. And the responses in the market with the 30 plus insurance companies that we work with is all over the map. So we try to analyze very closely, very carefully on the front end, all of those risk factors so that we can make the best decision on which insurance product is going to be the most competitive. It's really amazing how much it changes. Every one of the major insurance companies are backed by reinsurance markets. And those reinsurance companies often set the rules that the main insurance company has to follow. And so we're very familiar with the nuances behind the scenes, if you will, with what markets do well in given situations. And then I think not only we spent all of our time so far this afternoon talking about amounts of coverage and limits of coverage and making sure that we're protecting the right things, but we also have to spend some time talking about how long do I need this? And that's really a big issue. I tell anybody that'll listen, you ought to have at least 25% of your overall coverage in permanent insurance. Should not be a point in your life where just all your life insurance goes away and you've got no liquidity whatsoever, whether it's for a business or whether it's for family use. It's important to have some coverage that's got some legs to it. And if you're buying a term insurance policy when you're in your 30s or 40s, and you only buy 25% in permanent insurance, by the time you're in your 60s and 70s with normal inflation schedules, it already is a significantly reduced amount of money that you've got to begin with. I'm a big fan of having a mix of some term insurance that gets you to the point where you've taken care of some of the big obstacles in life, like mortgage, like getting through kids through education, um, through to your retirement years, but then to have some life insurance that's not going to go away. It's going to be there for as long as you shall live. When you get into the permanent insurance contracts that allow you to have coverage that lasts forever, there are also some other nuances that are in the policies. So some of them can be designed with long-term care protection, where you've got some dollars that are there that could take care of home care or facility care. Some of them have chronic illness provisions or terminal illness provisions, where if you need to tap some of the death benefit prior to death to be able to assist with some of those expenses, that's possible. In fact, some of the term policies that we have in the marketplace today offer chronic, critical, and terminal illness provisions that give you a little bit more flexibility during your younger years, that if you were unfortunate enough to need to have to tap dollars earlier, you could do so. And so when we look at insurance contracts in the marketplace, we can show you, products that have some of those provisions versus products that don't, and let you make a discerning decision as to what makes the most sense for you. We also look at conversion. If you've got a term policy, can you convert it to a permanent policy if you've had a change in health, or just because you now are in a financial position where you can secure the permanent insurance? Most of the marketplace, the conversion features have dramatically changed in the last 5 years. It used to be if you bought a 20-year term policy, anytime in that full 20 years, you could have converted it to a permanent policy. That's not the case today in the market. So the analysis that we try to bring to the table is to look more than just at the price and the limit of coverage, but what provisions are also inherent in that policy. And it's amazing the small differences that can be there in premium between one that has full conversion, one that has living benefits to deal with chronic and critical illness, versus one that doesn't. Sometimes it can be just $5 a month difference in premium to bring those additional provisions to the policy and the family protection. Life insurance for the living, certainly it is taking care of all of those expenses that we talked about, whether it be the mortgage or income replacement issues. But life insurance also can be positioned to deal with other areas too. You got a 401k and you're highly compensated and your employees don't contribute as much as you would like. It's going to restrict how much money you can put into a 401k. Life insurance, when you're buying a permanent insurance contract, can be designed to have money fit into the policy to have the cash value grow in the contract. And if it's designed appropriately and correctly, you can actually take tax-free money from the life insurance policy during your retirement years. So it's basically creating another bucket of money. You might have some money in mutual funds, some money in your retirement qualified account, like a 401k or a SEP IRA. And then you may have money in a life insurance contract that operates like a SEP IRA or like a 401k, where you are putting the money into the contract, obviously with after-tax dollars, but it's growing tax-free, and the distributions can then be received from the contract tax-free. So it's nice to have some flexibility in having different retirement assets. I tell people, listen, you may not want to have your life insurance be the largest portion of your retirement income stream, but it's nice to have it be a small portion so that if the tax rates become exorbitantly high for a number of years, maybe the life insurance bucket of money is the place that you go to tap for retirement during those years, and then you go back to your 401k when the tax rates come back down. And certainly in the last 40, 50 years, we've seen tremendous swings in income tax rates all over the place, just as we have seen the same with estate tax rates. And life insurance, when one's got a net worth that's of some significance really can provide tremendous liquidity to take care of estate tax issues, so that property or other assets don't have to be liquidated in order to pay the tax. Right now in the state of Maryland, there is legislation that, if it's passed, will reduce the Maryland estate taxes all the way down to $2 million a person. So it impacts a lot more people than we normally think when we think of estate taxes. We usually think of the billionaire. That's no longer the case, especially if we live in Maryland. And then federal estate taxes, the same thing. At the end of this year, the limit that currently exists is scheduled to be cut pretty much in half. So more people will be impacted by federal estate taxes after this year, unless they extend the sunset provisions. So jury's out on that. Still what will happen. But life insurance, when it's put into a trust, can certainly create tremendous liquidity to address the estate tax issues. I already mentioned the chronic illness that's on there. So here's a little bit with the term insurance and the permanent insurance. And we've hit on this a little bit in that, term insurance is just that. It's for a finite amount of years. Maybe I've got a small business loan for 15 years and I set the policy up for that period of time, versus the permanent insurance. If it's designed the way that it should be, it'll live as long as you possibly do. And whether you use the policy to have cash building up in it, or you just have the permanent insurance designed to be a lifetime contract, with just pure protection, you can go either way. And again, that's the advantage of having so many different insurance companies and so many different products. In fact, most of the insurance companies we work with have 3 or 4 different types of permanent insurance contracts, depending upon the goals that the individual has. So we'll spend a little bit of time this afternoon, probably 15 minutes or so, talking a little bit about long-term care. Long-term care really addresses a lot of financial issues that can happen later in life. But unfortunately, in my experience, I've had a number of people that have had issues earlier in life, whether it be car accidents, strokes, whatever it may be. So we'll go through this a little bit here. There is definitely a massive impact upon family, home, and the nest egg if somebody has long-term care experiences. A lot of people think that health insurance addresses long-term care. It is not designed to do so, nor is Medicare. Medicare has very limited benefits if you've been in a hospital and if you've been there for 3 days. And if you receive skilled care, then you've got some limited benefits for a number of days for Medicare. Other than that, pretty much useless for long-term care. And Medicaid is an impoverishment program. So if you wiped out all your assets and you're in a facility, then Medicaid can take care of bringing the protection. Used to be individuals bought long-term care insurance when they were 65 years old and they were looking at Medicare supplements. Now the average age that people are looking at long-term care is in their early 50s, with many addressing the issue even sooner. There is tremendous difference in cost by doing it at an earlier age versus later. And insurability issues too, because a lot of people unfortunately have changes in health when they get into their late 50s and 60s. And so the earlier the better. A lot of times we look at long-term care and we think of facilities. For myself, my first line of defense is home. I'm not going to a facility unless they bring me locked up. So somebody's trying to come back in. I think I let him in. But home care is where I want to have protection. In order to have protection, certainly Medicare does not deal with home care. Medicaid doesn't deal with home care. Your private health insurance doesn't deal with home care. So, long-term care coverage does deal with home care and lets individuals come in. It could be more skilled individuals from RNs to, therapists to just a homemaker service that's providing assistance that can deal with that. Also, good coverage addresses assisted living facilities and nursing homes as well. Cost for care right now, $28.33. I've got a number of clients right now that are paying $30, some that are paying $36. Really depends on where they live and whether they're able to find the care providers to bring that assistance home. Assisted living facilities, certainly to get a one-bedroom single occupancy is more than if you have two people in a room. Same with nursing homes, semi-private versus private. That's a lot of money, $113,000 a year. So we go back to the conversation at the very beginning about financial impact. Many of us are going to retire with a pretty good nest egg. If we've got $113,000 bleeding out of that nest egg per year, that has financial consequences for a surviving healthy spouse, for legacy goals that you've got, everything else, outliving your assets that you've got. It's a pretty significant amount of money that one has to contend with long-term care issues. This just deals a little bit about how you would pay for it. Everyone has made a decision on long-term care. If you haven't bought coverage for long-term care, you've made a decision that if something happens, you're going to use whatever assets you've got to take care of those care costs, whether it's a spouse that's needing the care or the individual themselves needs the care. You've transferred. I kind of equate it a lot of times to a house. You pay all these years on a mortgage. When you get to the end of it and you've paid off that house, do you keep homeowners insurance? Almost everybody does. Not required to anymore. But why would you want to have to rebuild your house with your own retirement assets that you've worked your whole lifetime to accumulate if you could transfer the risk by continuing to have homeowners insurance, even though those rates have come up significantly in this hard market that we're in, insurance hard market. But long-term care is kind of the same thing. You built up a nest egg that you've worked your entire lifetime to accumulate. You've created equity in your house because it's appreciated hopefully in value and you've paid off that note. And long-term care insurance is basically saying, I'm going to transfer this risk, this liability from my balance sheet to an insurance company. And then my kids are not going to have to worry about where the money's going to come in from. How many days a week can they afford to have somebody come into my house? And frankly, not going to have to worry about the kids having to change my diapers and feed me and bathe me and everything else that I don't want my children to be a part of. So, different ways to pay for it, whether it's taking it out of your own assets or it's taking it out of insurance. It's one of these policy types that you design with your own financial situation in mind. So if you know your retirement income is going to conservatively generate $6,000 a month during your retirement years, and we're looking at care costs of $11,000 a month, you don't need a long-term care policy that necessarily provides the full $11,000 a month. Maybe you only need the difference between those two. And that can help to get the costs a little bit more affordable for the insurance coverages themselves. Stay at home. It's amazing with the technology that's come along, whether it's the elevator that can get you to the second floor, whether it's the types of devices that can help lift people at home, the types of beds that can be brought into the home today, the modifications that can be made to allow somebody to stay in their own home is encouraging to me. And if that's your first choice to stay at home, no matter what, it's nice to know that there's a lot of advances in that technology that affords that choice. When you're looking at the insurance contracts, there are a couple different ways to do it. You can design the policies to deal with reimbursement for benefits, or excuse me, reimbursement for costs that have been incurred, or you can deal with what we call an indemnity contract where there's cash that comes in per month once you've triggered a claim for long-term care. And this is probably a good point to talk about that triggering mechanism. Triggering for long-term care is done either by a cognitive change in health where somebody is needing to have assistance, or their inability to do 2 out of 6 daily living requirements: eating, bathing, dressing, toilets, transferring, mobility issues. Okay. So the 2 out of 6 or the cognitive change is the triggering mechanism for long-term care. When you're looking at the policies that are in the marketplace, not only is there a difference between indemnity contracts, which provide a given fixed cash amount per month, and reimbursement contracts that reimburse you for the cost incurred up to your policy limits, but there are also differences in overall designs. A traditional policy, you are basically creating a bucket of money. So I gave an example a minute ago of if you've got income coming in of $6,000 a month and the care cost is $11,000, your net amount might be $5,000 that you need to have, for protection purposes. How many years do you need that? I don't have a crystal ball, but most of the time when we're looking at long-term care coverage, I want to have a policy that pays a claim for 4, 5, or 6 years, so that it deals with the vast majority of the situations that might come along to me, as far as medical. So if you think that through mathematically, let's take a policy for $10,000 a month with a 48-month benefit period. That's a bucket of money that I just created of $480,000, just multiplying the months times the amount of dollars that I've got. And then I would always want to have an inflation provision on that contract so that every single year my monthly benefit goes up and my overall bucket increases in size. Otherwise, the policy could potentially become irrelevant with inflation over time. So simple math: how much per month do you need? For how many months do you need it? Put an inflation rate on it. That's your bucket of money that you're creating with long-term care. With a traditional policy, you pay the premiums every year for as long as you shall live. There can be a rate increase, and there has been rate increases on the traditional policies, but they're the least expensive way of securing long-term care protection. For the hybrid contracts, they are a long-term care policy that sits on a life insurance contract. And those premiums are typically designed to be shortened in pay. So it could be a single pay, could be a 10 pay, could be a pay to 65. And the premiums are contractually guaranteed. So at the end of that period of time, there is no more cost. If you start at 55 and you bought a 10 pay at 65, when you retire, your long-term care policy is a paid up contract. And there is a death benefit. So if you never use the long-term care, there is a recoup back to your heirs of a tax-free death benefit that comes in. So a lot of individuals like the hybrid type contract because they're allocating money. They can pay it up and not have it be an expense during their retirement years. And if they never end up using it, which is the best scenario for all of us, believe me, then we got a tax-free death benefit that comes back in, because you're either going to have long-term care or a death claim or both. So it's good to have some flexibility. And again, having access to all the different products that are in the marketplace, both in the traditional space and in the hybrid space, we try to tailor make it to what the goals of the individual are in that design. Some companies might be better on a single pay, others might be better on a 10 pay, others might be better with the traditional design. So we look at those comprehensively and try to get a handle from each client as to where there are important areas that they want to address. And again, like the life insurance, it's underwritten. So we have to look at each individual's health and histories to find out which insurance company is going to handle that the most aggressively as well. So that's what we try to do in the long-term care space. To me, it's a critical mechanism for protection. And I've been dealing with long-term care insurance for over 30 years, and the number of claims that I've assisted with is mind-boggling, from broken hips to severe dementia, to I got to get my back fixed because it hurts a lot, to causing paralysis and being in a wheelchair for 9 years with one gentleman. I have seen a lot in the claims arena in long-term care. And unfortunately, right now I'm going through it right now with a parent, but I'm blessed to have insurance coverage that's at least easing that financial burden. And to me, that's a good part of the policies, is that you're making sure that the care that's necessary is not going to be provided by the adult children. It's going to be provided by a professional, or in a professional setting where professionals are providing it, rather than a family member. And you're not worried about the affordability of that care because the insurance contract is funding it. It's kind of a quick glance at long-term care, but we're here to assist in either the insurance on the life insurance side or the long-term care, to help plan, make sure that we're addressing all the exposures that you're concerned about, and want to be a resource to help you as best we can.
I had a question about I mean, I know you mentioned that it was is it that you're like supported by professionals with the plan? Is it possible to like support a family member if they choose to try and take care of another family member through this, or is it like
In most of the situations, you want to have a licensed care provider that's providing the assistance.
right?
If you have an indemnity contract, once the claim is approved, you're getting a flat amount per month. So let's say I want to have a nurse come in 3 days a week and I want to have family take care of the rest of it, and the nurse is only costing half of what my monthly check is coming in from the insurance companies, and you want to allocate money towards your children that are providing the care, certainly you would be able to do so.
Right.
You know,
Sure.
but that's a big difference between an indemnity contract and a reimbursement contract. Good question.
One just came through that asks if you are at a long-term care facility, are there any of the cost/care provided by covered by Medicare, sorry, and is there a way to declare any of the costs for tax purpose?
So,
Okay.
certainly, if you've got a long-term care policy, the facility is going to charge you a given amount per month. And if your policy is, an indemnity contract that's paying that flat amount a month that's higher, then, all the costs for that facility are going to be covered. If your policy is set lower, then it's going to be a combination of both. Medicare and Medicaid just are not designed to deal with long-term care. Medicare only covers if you're receiving skilled care and after a 3-day hospitalization, and then you're into a facility, it's going to cover it. So first 20 days you're on your own, and then the 20th day to the 100th day, you're going to have some benefits that are paid for from Medicare. But after the 100th day, you're on your own.
Yes.
And even from the 20th day to the 100th day, it's an offset.
Interesting.
Yeah. Yeah, a lot of people want to check the box that I got it because they've got Medicare or they got a Medicare supplement. Medicare supplements don't address it either. Weren't designed to, they're not priced to. The long-term care really is its own beast. We're certainly grateful that you all joined us this afternoon to go through these issues, and I'm sure everyone will be getting the email from Sarah with the link that we posted in the chat here, and look forward to following up with each of you with individual assistance.